Most people have a number in their head, some vague, half-formed figure they've never actually stress-tested. $1 million, 10 grand a month. Enough to not worry, but vague numbers don't pay rent. And in Australia in 2026, with grocery bills, mortgage repayments and energy costs all sitting at levels our parents never had to deal with, the gap between "I think I have enough" and actually having enough can be the difference between genuine freedom and a very expensive mistake. So today I'm going to give you the actual number, not a motivational estimate, the real figure you need in passive income to quit your job in Australia, how to calculate it for your specific life, and the most realistic ways Australians are actually building it. Let's start with the foundation. What does passive income actually mean in this context? True passive income is money that arrives without you trading time for it. Dividends from shares, rental income from a property, distributions from an ETF, interest from bonds or savings. A business that runs without you. The defining characteristic is that if you stopped showing up, the money would still come. That's the standard we're working to. Now, the first question isn't how much passive income you need, it's how much you actually spend. Most Australians have no idea what their real monthly expenditure is. They know their salary, they know their rent or mortgage. But the full picture, groceries, insurance, subscriptions, petrol, eating out, kids' activities, clothing, medical, the random Tuesday afternoon coffee that somehow becomes a daily habit, that full picture is usually 20 to 30% higher than people estimate when they sit down and actually count it. So before you can set a passive income target, you need a spending number you actually trust. Pull 3 months of bank and credit card statements. Add everything up, divide by 3. That's your real monthly spend. For most Australian singles living independently, that number lands somewhere between $3,500 and $5,500 a month. For couples, particularly those with kids, it's often $6,000 to $9,000 or more. Once you have that number, you have your target. Your passive income needs to at minimum match it, and ideally exceed it by 15 to 20% to account for tax, inflation, and the unexpected costs that will absolutely show up. Let's use some real benchmarks. According to the ASFA retirement standard, a comfortable single lifestyle in Australia costs around $54,800 a year. A comfortable couple costs around $77,000. These aren't lavish figures. They include private health insurance, a car, regular dining out, and a domestic holiday each year. If you're younger and working toward quitting your job rather than retiring, your costs might be higher because you're not yet at the stage of life where spending naturally drops. A realistic passive income target for a single Australian wanting to quit their job and maintain a comfortable life is somewhere between $60,000 and $80,000 a year after tax. For a couple, that range is more like $85,000 to $110,000. Now let's talk about how you actually generate that. Because passive income isn't one thing. It's several different asset classes with very different entry points, risk profiles, and yields. The first and most accessible path for most Australians is dividend investing through ASX shares and ETFs. The ASX 200 has an average dividend yield of around 4% in 2026. Add franking credits, which are tax offsets attached to dividends from Australian companies that have already paid corporate tax, and that grossed-up yield rises to around 5.5%. If you tilt your portfolio toward higher-yielding names, you can push that to 6 or even 7% grossed up. Using 5.5% as a conservative, realistic yield for a diversified Aussie dividend portfolio, here's what the numbers look like. To generate $60,000 a year in passive dividend income, you need around $1.09 million invested. For $80,000 a year, you need roughly $1.45 million. These are real numbers. They're not small, but they're achievable for someone who starts early and invests consistently. The second path is property. Australia's relationship with investment property is well documented. A positively geared rental property, meaning one where the rent exceeds the mortgage and costs, generates passive income directly. In practice, finding positively geared properties in major Australian cities has become extremely difficult as prices have surged. Regional areas and certain interstate markets offer better yields, but they come with different vacancy and management risks. A realistic net rental yield after mortgage, rates, insurance and property management fees on an Australian investment property sits somewhere between 2 and 4%. Property can work, but it's capital intensive, illiquid, and far less passive than most people assume when you factor in maintenance calls and tenant issues. The third path, and one that's increasingly relevant for Australians with specific skills or audiences, is digital income. Online businesses, content creation, licensing, royalties, affiliate income. These can generate genuinely passive income once built, but the build phase is anything but passive. They're better thought of as a business you eventually systematise rather than a passive stream from day one. For most Australians, the most realistic and scalable path to passive income is a combination of the first two. A growing share portfolio generating dividends supplemented by one well-chosen investment property. The shares provide liquidity and compounding. The property provides leverage and rental yield. Now let's talk about the tax reality, because this is where a lot of people's passive income plans fall apart. Passive income in Australia is generally taxed as ordinary income. Dividends, rent and interest all get added to your assessable income and taxed at your marginal rate. If your passive income is $80,000 a year and that's your only income, your tax bill under current rates would be roughly $18,000, leaving you with around $62,000 after tax. That's workable. But if you're still working while your passive income grows, that passive income gets stacked on top of your salary and taxed at your highest marginal rate, which can be 37 or even 45%. This is why structuring matters. Franking credits help significantly for share investors. If your portfolio is generating fully franked dividends, a large portion of your tax liability is offset by the credits attached to those dividends. A low-income earner or someone with no other income can receive franked dividends up to around $30,000 a year and pay almost zero net tax. Holding income-producing assets inside a family trust or through a self-managed super fund in pension phase can also reduce the tax drag significantly. These structures aren't for everyone, and they come with setup and compliance costs. But for someone building toward $80,000 or more in annual passive income, the tax savings can be substantial enough to justify the complexity. Now let's build a realistic timeline. If you're starting from scratch and you can invest $2,000 a month into a dividend-focused ASX portfolio averaging 8% total return per year, including both capital growth and reinvested dividends, here's what the compounding looks like. After 10 years, you'd have approximately $365,000 invested. After 15 years, around $670,000. After 20 years, roughly $1.18 million. At that point, a 5.5% yield generates about $65,000 a year in passive income. That's enough to quit. Bump that monthly contribution to $3,000 and you hit $1 million in around 17 years. $3,500 a month gets you there in 15. These aren't get-rich-quick timelines, but they're real, and they're available to any Australian household willing to live below their means and invest the difference consistently. The single biggest mistake people make when chasing passive income is optimising for yield before they've built enough capital. Chasing a 12% yielding stock on the ASX because it sounds like a shortcut is almost always a trap. High yields on individual ASX stocks almost always signal either a collapsing share price or a dividend that's about to be cut. Both outcomes destroy capital. The boring, sustainable path is building a large enough base of quality assets that even a moderate yield generates the income you need. Here is the simple framework to take away from this. Step 1. Calculate your actual monthly spend and multiply by 12. That's your annual income target. Step 2. Add 20% as a buffer for tax, inflation, and unexpected costs. Step 3. Divide that total by your expected net yield. 5.5% for a diversified Aussie dividend portfolio is a reasonable starting point. The result is your passive income portfolio target. Step 4. Work backwards to figure out how much you need to invest each month and for how long to hit that target. Step 5. Build it, automate it, and don't touch it. The path to quitting your job through passive income in Australia is not mysterious. It is not reserved for high earners or people who got lucky with property in the 90s. It is arithmetic, consistent inputs over a long enough period in the right asset classes with tax considered from the start. The Australians who get there are not smarter than you. They just started and they didn't stop. If this helped you get clarity on your number, subscribe and hit the bell. Next video, I'm going to break down the exact ETFs most Australian passive income investors are using to build their portfolios in 2026. See you there.